Everybody, Marty Missouri, good morning. 7th of June, 2017, your weekly video. Today I thought we'd spend a few minutes on sectors, see if there's any signals that they are sending relative to the economy and maybe the momentum in the market. And then I'll just finish up with kind of a broader look. Each chart is normalized to 100 when it says 108.87, as it does here for technology. That says that so far this year, technology has outperformed the broader S&P 500 by 8.8%, which is a substantial outperforming. So tech stocks are having a banner year so far in 2017. Financial stocks are not. 92.7 means that they're underperforming the S&P 500 by about 7.3% so far this year, which is a substantial underperformance, particularly for a sector that's pretty cyclical, that we came into the year with a great deal of optimism on. So financials, which is an 18% target in our portfolios, is really having a rough go of it so far this year. I showed you last week in the weekly message that valuations were very, very low, and we remain relatively optimistic on the sector in the U.S. And I'm going to show you here in a minute what's going on in other parts of the world. Consumer discretionary, beating the S&P by 3.25%. So consumer discretionary stocks, think Amazon, Starbucks, etc., having a very good year so far this year relative to the broader market. Materials underperforming the S&P by 0.5% so far this year. Came into the year with some optimism on materials. If we're really in that stage of the cycle, which sees some acceleration going forward, if we get some infrastructure spending and so forth, technicals don't look bad, so we're keeping our 15% target to materials. Energy has completely fallen out of bed, underperforming the S&P by 20% so far this year. That's what that 80 suggests. We lowered our target from 10 at the beginning of the year all the way down to 6 so far. Very cyclical sector. Under normal circumstances, if we are in the cycle where we believe we are, energy would be doing quite well. We don't seem to have a demand problem, but we have tremendous supply. The moment Russia and OPEC try to limit production to boost the price, North America responds with production increases. Therefore, we have lower prices, and it's been problematic for the industry. Industrials, another 15% target, just about break even with the S&P 500. Reason to be optimistic on industrials going forward, so we're keeping our allocation there. Staples, 8% of our portfolios, up about 2% above the S&P 500 this year. Would not be what I'd predict at this juncture. If, again, the economy is really beginning to gain some steam, you would expect staples to underperform the broader market. Same with utilities, especially if interest rates are going to be on the rise. And healthcare, up 3% over the S&P 500. Again, a defensive sector that's doing well. So, folks, that would be the definition, I think, of mixed signals. When you look at technology and consumer discretionary really just outperforming dramatically, particularly technology, that says good things about the economic outlook. But when you have utilities and you have staples also outperforming, that says concerning things. So asset markets are really giving us a mixed picture. It's going to take time for things to shake out, and I'll be here to report on those for you. Another view of financials, though, because I mentioned how the fact that they're underperforming quite measurably, not necessarily everywhere else. Now, our allocations are global allocations, so we do have notable exposure to places like Europe in the financial sector. And as you can see, European financials so far this year, while they've come back some, relatively speaking, here of late, they're still 6% on a year-to-date basis better than the S&P 500. So the fact that we have 18% financials does not mean that we're giving up gains on 18% of our portfolio. In fact, a chunk of that is actually doing very well, and that's the stuff we have in Europe. And it's a similar story for emerging markets as well. Speaking of non-U.S., here's a look at the Europe, Australasia, and Far East Index. Here's the Morgan Stanley Emerging Markets Index. As you can see, the Europe, Australasia, and Far East Index is outperforming the U.S. market by 4%. Emerging markets by 8%. So as you might imagine, on a relative basis, our portfolios are doing well this year because of that foreign exposure. And then lastly, in closing, here's a 20-year chart of the S&P 500. I've shown you this analysis before in terms of these consolidation boxes. These are periods that we can define as sideways moves. Now, as you can see, you can get very volatile within these sideways moves. Here we are in 98, and then when the dot-com bubble peaked, and then we have the bottom of that in 2002, 2003. So these would be periods where you might say gains or losses get digested. And then from there, you tend to break out of those boxes in a pretty meaningful way in one direction or the other. So as we sit in these sideways boxes, a really long one recently that we can define, are there any indicators underlying those that might give us a clue as to where the market goes from here? And certainly there are. And there we go to our basic, for illustration purposes, moving averages. The green is the 50-day moving average, simple moving average for the S&P 500. The purple is the 100. The blue is the 200. So here's those consolidation boxes duplicated below. So as it looks like we're breaking out either to the upside or the downside, have the moving averages given us any clue in terms of probabilities going forward? Well, of course they have. Here, breaking out of this one in 1998, we had the fast ones on top of the slower ones, and that is a very bullish look right there. That's about as bullish as it gets. We had a very nice run coming out of that to before the market began to peak. As it peaked, as we consolidated and came out below the low up here, and we had a whale of a bear market after the tech bubble burst. Here we are coming out of this box with a very bullish look, had a real nice run in 2003, consolidated those gains, broke out of this box in 2005, pretty bullish look there, nice run into the peak, the mortgage/real estate bubble, we'll call it. Broke down below. Take a look at the moving averages, very bearish look, worst recession, worst bear market since the Great Depression. Came out of that in 2009, moved into a consolidation box here, came out of that with a very bullish look. And here we are coming out of that nauseated sideways channel we endured from 2014 well into 2016 with a very bullish look in the moving averages that remains today. So folks, when we look at this analysis or analysis like these, which we won't do today on the various sectors as well, we're allocating portfolios consistent with what these signals are telling us. We are seeing some retracements like in financials that are hitting some retracement levels that seem to make some sense. But right now, these are things that are happening within the context of an ongoing bull market. So until things change, we're going to be pretty growthy in our sector allocations as it relates to equity exposure within client portfolios. But we're going to keep an eye on things, and each week, once a week, I'll come and report to you some of the things we're thinking about and some of the things we're seeing in the indicators. Thank you as always for watching and listening, and look in the next few days for my weekend message. Take care. Bye-bye.